And to finish off, it's been been focusing so much on the housing crap in our faces, obscene auto subprime crisis, retail apocalypse, etc. Foreclosures back up again, bankruptcies, both personal and corporate, back up again, etc. Because that's been in my face, so I must reciprocate it and put it into your face. Been a little while since I talked about the pensions, as in maybe just a few weeks. Zero Hedge has a beautifully written article which tells me the stock market has to come down. There's going to be so much pressure being put on this giant stock market, all pieces, equities in general. It has to be soon. Are corporate pensions about to start dumping their $1 trillion in equity holdings? They make a fantastic case as to why they just may in fact need to do that. Zero Hedge. Several large public pensions around the country are in serious trouble. And after several years of paying out more in distributions than they take in, which is a textbook definition of a Ponzi scheme, by the way, many are just one more equity market crash away from completely running out of cash. In fact, we recently wrote about how Chicago's largest pension fund could run out of cash within 4 years if such a scenario played out, which they link to that article. If you want to see it, check my description box. And while we hate to be pessimistic, let's just look at what happens if, by some small chance, today's market gets exposed as a massive bubble and we have another big correction in 2018. And I'll add, it might not be the 2018. Again, I think September, October this year could be the point of ignition, if you know what I mean. So such a correction would force the fund to liquidate over $1.5 billion in assets in 2018 alone. And the system would run out of cash completely within 4 years. And with public pensions, and while public pensions may be forced to continue swinging for the fences by allocating more and more capital to equity markets, corporate pension funds, according to Bloomberg and Morgan Stanley, are growing a little weary of Yellen's equity bubble and may be looking to rotate capital into corporate bonds instead. And if they do that, that means they have to take an enormous amount of money out of the stock market. And one pension fund will do it, another one will do it, another one will do it, which you take money out for each seller, there has to be a buyer, right? And you may say, yeah, the buyer right now is the Federal Reserve. But what did Lindsey Williams also say about the Federal Reserve? They could only do this for so long. They'd only buy and prop up for so long, and then it would stop. It would have to stop, and they would stop. He said that would happen. And that was going back years ago when Ken Fromm, the good guy that was very accurate, was alive. And while public pensions may be forced to continue swinging for the fences by allocating more and more capital into equity markets, corporate pension funds, according to Bloomberg and Morgan Stanley, are growing a little weary of Yellen's equity bubble and may be looking to rotate capital into corporate bonds instead. Company pensions are nearing a tipping point that's poised to send them on a buying spree in the U.S. corporate bond market. The retirement plans, helped by gains in stocks, are edging closer to digging themselves out of a hole they've been in for some more than a decade. A shift that is cutting their demand for risky assets like equities and stoking their interest in more stable investments like company debt. And I've got to be honest with you, I don't know that that's a really more stable. Anyways, companies on average have about 82% of the funding they expect to require for retirees' pensions, compared with around 75% in the middle of last year, according to strategists at Morgan Stanley. Once pensions are around 80% funded, they tend to increase their bond holdings and cut their stock investments to lock in gains. Morgan Stanley analysts led by Adam Richman wrote in a report on Friday. They funnel much of that money toward high-grade corporate debt, especially longer-dated bonds, to help fund their decades-long obligations. That trend is already happening and could now intensify, according to Morgan Stanley analysts. U.S. company pension funds own more than 1.8 trillion of assets, and even small changes to their allocations can lift already high prices for bonds and weigh on stocks. In all, non-public pension funds held just over 1 trillion in equities at the end of 2016, or roughly 31% of their 3.3 trillion in assets. Obviously, reducing that equity allocation target by just 10% would therefore put about 330 billion worth of selling pressure on equities, the stock market. And that's assuming public pensions don't follow along, and they very well probably will. Of course, by choosing to do the right thing and de-risk their portfolios, these massive pension funds could very well become the catalyst that brings Yellen's massive asset bubbles crashing down. So if you're going to get out, probably best to be a first mover in what will become a race to the bottom. Yeah, so pension funds, retirees, the people that manage those, they have to look out as best as they can for the retirees', best interest. And generally speaking, as he says, when they get to 80%, they want to turn that spigot off and put it, that's a bit risky. We got there now. Let's take our profits and let's go over here. And if one pension fund, large one, does it, do you really think the other ones, we're not going to do it? It's going to be a general consensus kind of thing for the same reasons. So one's going to do it, another one's going to do it, but those are just the private ones. What about the public ones? Oh, well, the private ones are doing it. We're pension funds too, so we should probably do it too. Not just because they're doing it, the timing's right for the same reasons. But what if they don't get out in time? What if the crash happens later this year and they just didn't get out in time? Boy, oh boy, is that not going to look good. And thinking of some of the Webout reports that talk about white-haired and gray-haired people protesting even violently at places like, retirement, Social Security office, things like that. If that forecast comes true, sounds like there's an issue one way or the other. But the point of this actually is that if they start doing this, it'll put massive pressure on the stock market. Massive sell orders. And who's there to buy it all up? Again, maybe the Fed will step in again. Buy it all up. Let them make the transition. But then again, maybe not. Maybe we have a debt ceiling problem of epic proportions. Maybe that causes a market crash. A lot of maybes out there. But push the maybe stuff aside and look at, again, the hard data that I always talk about. Everywhere I look, when I say there's nothing, I'm not kidding. There is nothing. There is no data, not even a smidgen, or as little Ashley would say, a pinch. Just do it a pinch. Not even a pinch of data that says, this market could do well because of XYZ. Again, we as in the government, Trump still has to deal with his tax resolution, solution. We got to bring down taxes, corporate tax. We got to get on that. Dude, we're not even past repealing Obamacare. We're not even past the debt ceiling, which everyone's at recess in Congress. So we have 4 days when they get back approximately to put something together. And hope that all the different groups, Democrats and this group and the Freedom Caucus, all that, agree to it. And if you have anything in there for Planned Parenthood, we're not going to do it. If you have this, we're not going to do that. My goodness. So that's first thing. They still got to deal with Obamacare. They still got to do the corporate tax thing. The Trump election, ride the Trump train. Well, I hate to say it, but the Trump train seems to be fading, and kind of fading fast. And if they don't come to an agreement by the end of April, Congress, which again, they have 4 days at the end of the month, they don't come to the agreement to do anything with the debt ceiling, it's not going to look pretty. And again, I can't help but to think the next month, May 11th, so just a week and a half later, May 11th was the date the dude who got all the chart stuff right and made predictions, always got them right, says that's the most troubling date for me. That's the one we really need to pay attention to. That one could be bad news for the markets, whatever that means, for whatever reasons. If he didn't have a track record, who cares? Whatever. And in case you're wondering, I'm going to pause this for a second to find out his name. I cannot remember his name. You know, I get new subscribers every day, and they may want, well, who is he? Who are you talking about? Let me go find it real fast. Hang on. All right, found it. Crash Guru warns the Dow could plunge to 14,800. A sign could come this week, posted March 14th. But it was actually March 13th that this guy said, and his name is Sandy Jadeja. Jadeja. Okay? And I feel like I kind of want to read this again, a little bit of it. But if the stars collide as one chartist predicts, and again, he has a very high track record, blue chip gauge could soon plunge by more than 6,000 points to 14,800. That's nearly 30% lower based on Monday's close. Sandy Jadeja, chief market strategist at Masters Trading Strategies, claims several predicted stock market crashes to his name, all of them called days or even weeks in advance. He told CNBC viewers, for example, that the August 2015 flash crash was coming 18 days before it hit. He's also made prescient calls on gold and crude oil, and he's extremely concerned about what this year could bring for investors. He says the timeline is rapidly approaching for the next potential Dow meltdown, he said, who shares his techniques via workshops and seminars. Timelines are at the heart of his predictions, which he bases on repeating cycles in the market that are connected to specific times. People need to look for three things, he said. Price, pattern, and time. You can get the price pattern wrong, but if you get in at the right time, the other two don't matter. He sees 2017 as littered with pitfalls for the Dow Jones. Below is his so-called timelines chart of the next stock index, defined by green horizontal lines. I'll show you in a second. He's currently on the outlook for the benchmark to approach that upper green line, which represents a range of 21,800 to 22,000 for the Dow Jones. And let me just show you this little chart. Notice these green lines are what he's talking about. Every time we hit a green line, boom, 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 right? So this is where we are. It's almost touching this green line. It needs to be around 21,800. However, it doesn't have to, he said. Okay? If it does, it'll just mean that the pullback will be harder on the Dow. The chart shows how the Dow Jones is edging ever closer to that higher green line in his target range. Once it hits that level, investors need to look for a weekly fall in the index, according to Jadeja, and then do something specific. He says, don't just go short, he said. That's where the public gets it all wrong. You have to wait for a break of the low of that weekly bar and put a stop above the high. And here's the crux of his concerns. If the rally inspired by last year's presidential election continues, the Dow Industrials could hit that 22,000 level. But if it fails, the pullback could be steep or even steeper based on history. One level down would take the Dow Jones to 18,600, while moving two full levels would bring it to 14,800, the one he mentioned. He says if the Dow Jones reaches 22,000, then there's a strong opportunity for it to pull back. It's nothing to do with trend lines or channels. These green lines are based on units of time and move forward step by step. As he has done in the past, he offers up specific dates around which he expects potential volatility for market declines. One of those is March 13th. And when this happened, I said, look, it's been a week now. This guy said, look, around March 13th, we had day after day after day after day of decline in the Dow Jones price. Then one little up and then decline. A couple more ups, and now we're back to decline again. And he called the date. However, he says that, but if that doesn't materialize, then he says, watch out for May 11th. He's more concerned about the latter date, May 11th, than the former date. Like a trip to 7-Eleven, He says, Jade is a frequent subject of media interviews and counts Robert Kiyosaki as a fan. The Rich Dad, Poor Dad author says his charts back up his own view that markets are going to pull back this year. It is possible that we can take the data and then forecast future. He says, is it possible that we can take the data and then forecast future turning points? After 31 years in the business, it's absolutely yes, he said. If more clarity on the chartist method is needed, here's another way of explaining how he has managed to get so many calls correct. He suggests visualizing a trip to a 7-Eleven. You would notice that in the morning, there's a rush at around 7 a.m. when people are going to work, then a lunchtime rush, then late afternoon rush, then evening rush. If you look at the data in a 24-hour period, then there's 3 or 4 periods when there's an increase of volatility. So when and how did that method pay off for Jadea? On July 31st, 2015, the chart specialist went on CNBC and warned of a major volatile move to come between August 7th and 18th, which turned out to be the so-called flash crash of August 24th. He also flagged another period to be careful of, September 13th to September 23rd. 9/23, you don't say. Interesting date, don't you think? Considering that there are some serious major astronomical or astrological alignments this year regarding that date, and you know how the club loves their esoteric stuff, occult stuff. Anyways, I wanted to find that and share it with you. Take care.